Assalamu alaikum. Uh, Welcome to the second lecture of grade 11 accounting. In this lecture, we will in fact do another question of final accounts. Let me brief you about the components of the final accounts. We have five components in final accounts, namely income statement, statement of financial position, statement of changes in equity, cash flow statement, notes to the accounts. Now, as you can see, first three topics are in white in color and the second two are in yellow in color. Well, the reason is that cash flow statement and notes to the accounts are not included in your course. Cash flow statement, you should know about cash flow statement. You will not get a cash flow statement in your exam question to draw it out. And there are not many questions asked on that. The first three topics, income statement, statement of financial position, and statement of changes in equity, are there in your course, whereas the other two are not. You must have a brief understanding of cash flow statement, and it's just that. In this lecture, we will do another question of cash flow statement. Sorry, not cash flow statement, income statement and statement of financial position. I hope you all have done the previous question. Doji. Yes. Probably we'll do two, three questions and then we will move on to the next topic, a new topic for class 11. Let's start off with the question. Thank you very much. Yes, the question says J. Jar trades as an important merchant. The following trial balance was extracted from his books on 31st March 2000. Purchases and sales, returns and words, customs duty, stock at 1st April 1999. This is the opening stock. Premises, motor vehicles cost opening, their provision for depreciation till before the start of the year. Provision for bad debts, insurance, vehicle expenses, wages, debtors and creditors, cash at bank, capital, drawings. I think everything is pretty clear. Returns and words will be subtracted from sales. Customs duty will come near that cost of goods sold. It will be a cost, and gross profit will be arrived at after this deducting this customs duty. It's a direct cost. I think the rest of the question is quite clear. Let's move on to the next slide and let me explain you the additional points adjustments of this question. Thank you. Additional information says point 1, stock on 31st March 2000 was valued at 12,600. This means this is the closing stock. This will come in the trading account, subtracted from cost of goods sold to arrive at the gross profit 1, and the next it will come in the current assets closing stock. Point 2, goods costing 6,500 were bought on credit from Collier Limited on 28 March 2000. No entry has been made in the books. Before the end of the year, before around 3 days, before 3 days the year ended, goods costing 6,500 were bought on credit. So this is a sales on credit and no entry has been made. That means accounts receivables will be increased by 6,500 and sales will be credited. Yani sales will be increased by 6,500. Accounts receivable debit, sales credit. Uh, Third, the provision for bad debts is to be increased to 960. First, we'll subtract the bad debts if there are any. Bad debts written off subtracted from accounts receivable. Whatever the amount remains, we will actually compare that amount. No, actually, no. No percentage is given, so we will directly compare the two amounts. The amount already given in the list of balances to 960. Whatever the increase is, only that increase will go in the income statement and it will also be subtracted from the accounts receivables. So these are the two places it will be recorded into. Point number 4, depreciation on motor vehicles is to be provided at 10% per annum using the reducing balance method. So it's quite simple. Reducing balance means we will subtract all the provision first from the cost of the motor vehicle. The entire provision till the start of the year, it will be subtracted. You will arrive at the net book value. Okay. What I'm saying is, I repeat, the provision for depreciation that is given to you all till the start of the year in the list of the balances, that will be subtracted from the cost of the motor vehicles first. You will arrive at the net book value, then you will apply 10% on that amount, and you will find the depreciation. Depreciation will be recorded in income and statement in operating expenses, one. Secondly, it will be subtracted from the motor vehicles non-current asset, two. So these are the four adjustments I've already explained, and requirements are quite easy. Trading and profit and loss account and the balance sheet. I hope you all will be able to do this question quite easily, inshallah. Thank you very much. I haven't provided the answers as yet. They can be provided upon request. First, do the questions yourselves, and let me see if you all can do and if you all can manage. Thank you.